Hi guys, this is Tim Melvin of the Tim Melvin Deep Value Report and the Banking on Profits newsletter, coming to you from down here in Central Florida. Nice, warm, soggy day out there. The dog and I already got caught in the first storm of the day. The second one should be rolling in here momentarily. Wanted to get to you guys with a video today, and I'm not going to touch on the macro stuff. There's not really any point. U.S. stocks are still riding low interest rates, flirting with new all-time highs. Small banks are still doing very well, and the rest of the world is riding the European QE wave, also pretty close to new highs, although there's been some pockets of volatility, of course, related to Greece. Greece is going to do what Greece does. Brazil is still a mess, and there's still issues in the Ukraine. There's your global update. Now, over the past few days, I've been putting together a series on Real Money, reviewing the earnings report released by Blackstone Group, of course, the large private equity firm last week. And went through the report, and it was a fascinating report. And I've spent some time exploring this week how individual investors might replicate the returns earned by Blackstone, because I have to tell you, they are exceptionally high, the returns that they offer back to their shareholders. Steve Schwarzman, in the pretty much the opening segment of the report, said, we like to give back 2.5 to 1 for every dollar our investors give us, and that's been going on over like a 30-year period of time. Well, that's returns depending on where you fall into the 5 to 7 year private equity kind of time frame. That's about a 20%, maybe a little bit higher rate of return for investors in Blackstone's funds. That's absolutely fabulous over a 30-year period of time. I think Apollo not long ago cited a return that was actually even just a little bit higher than that for long-term investors in their funds. So how can individual investors replicate those types of returns? Mr. Schwarzman said in his report that he doesn't think that anybody can do what Blackstone does. I heartily disagree with you. Here's the first thing that you have to do to replicate what Blackstone is doing. You've got to change your mindset, okay? Everybody wants to be the next Paul Tudor Jones or Jesse Livermore. Although why so many people emulate and love and respect and want to be like a guy who went bust 4 or 5 times over and eventually went so bust that he shot himself to death rather publicly in a New York City hotel is absolutely beyond me. But getting off track, you've got to change your mindset. You've got to get out of that trading short term. My stock's up 5% in 3 days. Let's sell it and bag the profit mentality that so dominates individual investors' behavior. It's been documented. Individual investors over the last 25 years have earned less than a rate of inflation in a time period where stocks, generally speaking, have done pretty well. We haven't even as a group been able to match the sub 4% returns of the market since 1999, because we're always moving in and out and trading around. Got it. Look, private equity thinks 5 to 7 years. The average holding period of a private equity investor right now invested is about 6 years. Compare that to the average mutual fund that's turning over about 100% of its portfolio every year, and you start to get some idea of just what you might need to do to get a little better at this investing thing. First, another thing that you have to look at is private equity, generally speaking, and they said it right on the call, okay, on the conference call. The president and chief operating officer said a lot of our returns comes because we can move in to these illiquid investments and hold them for an extended period of time. Quit worrying about whether or not you're going to be able to get off 1 million shares on the bid at a given point during the day. Odds are you're not trading 1 million shares of anything at any given point during the day. Liquidity is not that big an issue. What you want to do, adopt that 5 to 7 year time frame. Buy undervalued, unpopular assets at great prices and sell them at even better, at fantastic prices 5, 6, 7 years down the road when they've come back into favor, business conditions have improved, and people are anxious to buy them from you at very profitable prices from your point of view. So it's you've got to adopt the private equity mindset, lose the trader mindset, lose the short-term mindset, think long-term. The other thing that you see private equity buyers doing all the time, they're coming in to asset groups and sectors that are not extraordinarily popular at a given moment in time. Right now they're chasing European distressed loans. We're seeing them still showing up in the shipping sector. And of course, just about everybody's moved into the energy sector over the last few years. Most of them are active in some growth sectors as well. Private equity likes to get into tech at a good price, and if they can get into healthcare companies today at a reasonable enterprise value to EBITDA ratio, a lot of them are doing that. But they're very price conscious about what they buy. They want to see the business improve over that 5 to 7 year time period, buy it at a very low multiple, sell it at a very high multiple when it becomes much more popular. So think longer term, quit worrying about liquidity, and we're more than halfway down the road to replicating what the private equity guys are doing to earn such outsized returns. Now, one area where it is a little trickier for you and I as individual investors to replicate what the private equity guys are doing and the alternative asset managers is their credit strategies. Okay, just speaking out of hand, I'm not currently liquid enough to make a $25 million LBO mezzanine financing loan anytime this afternoon. The private equity firms are, and they been pretty generous about this. Apollo's got products out there. Blackstone certainly has their own products out there, closed-end funds, business development companies, real estate investment trusts that replicate the hedge fund credit strategies. So, with Apollo Commercial Real Estate Financing, ARI, you can be in the large-scale commercial real estate lending industry, just by buying 100 shares of a $15 stock that yields 10%. Same with the mortgage business. Both Apollo and Blackstone have mortgage-related funds. There's several business development companies out there that are doing direct lending in the middle market that allows you to replicate an awful lot of what they are doing with the credit strategies, and often you can partner right alongside them as you can buy into one of their affiliate REITs or business development companies. And the large scale real estate stuff, look, you can own pretty much the world as far as commercial real estate just by buying a few shares of Brookfield Property Partners, and you're going to find that what you're doing is really similar to what the hedge fund guys are doing, the private equity guys are doing, with large-scale commercial property ownership. So I think that while we can't do that directly, you and I are not going to buy, 3 blocks of the Manhattan Financial District, but Brookfield certainly can, and we can take advantage of the private equity guys' lending skills and expertise in some of these business development companies. These things, they're paying out between 8 and 12, 13, 14% in dividends. So the economy gets a little bit better in the years going forward. These things start to move up and appreciate a little bit in value, and we collect those dividends along the way. Again, we're getting further down the road towards having those total returns that look like those earned by private equity funds. So, and then, on the private equity side, let's invest in stocks like the private equity guys do. Let's apply a little common sense to the situation, okay? We're not looking to make 10% this afternoon. We don't really care what Apple's going to do today or what the stock might do tomorrow. You may care if you're particularly optimistic about the 5 to 7 year prospects for Apple, about buying into Apple, particularly if you can get it at a good price. But most people are trying to trade this earnings report, which is just silliness. You're betting on a guess that your guess about the analyst's guess is better than somebody else's guess, and that's just ridiculous. So think longer term. I'm just going to throw some stocks out there that I think really fit into the private equity mindset. Okay, written a lot about lately. Volt Information, VOLT. They're a tech staffing company that got into a lot of problems, and most of the problems had to do with lazy board and lazy management and a lot of family money in the company. Big changes there. Okay, the board has been changed, management has been changed. It just takes incremental improvements to the bottom line to really ramp earnings up here. There's huge tax credits and net loss carry forwards on the balance sheet. The intrinsic value of this company is at a minimum twice of what it's currently trading for. The interesting part there is the value is going to go up because they are disposing of non-core assets, including some Latin operations and some very valuable real estate in Southern California. This thing's trading below $10 a share. I think if you've got that 5 to 7 year time frame, it's probably worth well north of $30 a share over that period of time. Might be some bumps and bruises along the way, but I think you cash out for even more than the 2.5 to 1 dollars in, dollars out ratio that the Blackstone CEO talked about. How about Daktronics, DAKT? This is a really cool stock. And I got this just simply the value line list of stocks with the highest 3 to 5 year appreciation potential. And an associate of mine out on the West Coast, a good friend of mine, also owns the stock in his long-term portfolio. Now, they make Electronic signs, big scoreboards are doing, the new Atlanta baseball stadium is one of them. They've done stadiums all over the National Football League, Major League Baseball. Everywhere you see a big electronic sign, there's a good chance that's a Daktronics product. They also work with the state highway transportation departments, all those nice electronic signs that you see on the freeways. Look, we're going to have to spend more on infrastructure. There's going to be a lot more blinking signs out there saying, left lane closed ahead in the years ahead. But the real powerful market, they talked about it this year, one of the speakers at the Milken Global Conference, is electronic billboards are becoming all the rage. That's going to be a huge market that this company fits into. Now, Value Line's got it, tripling over the next 3 to 5 years. I'll go out to 5 and 7 and say, yep, we're going to get a triple, maybe higher on this stock. Now, looking just at that Value Line list, and I'm a Value Line junkie and have been for years, the highest stocks with the highest 3 to 5 year appreciation potential. What I'm giving you here are not recommendations. These are suggestions that you might want to look at because they're companies that you've heard of. And if you agree with the thesis and it plays out, you can enjoy some very private equity-like returns. But there's, out of favor companies on there like Weight Watchers, Avon Products. We've all heard of those. Hovnanian Homes is one that I like as a long shot. They're a little bit levered, but the housing recovery in my eyes is not going to be a spectacular thing, but just a long, grinding recovery. That's fantastic for a company like Hovnanian. They can just keep working, keep turning over the land inventories, and profits should just grow. And again, they've got tax loss carryforwards on the book that I think are actually worth more than the company. And they would have been, they would be trading at something like 80% a book if you added the tax loss assets back into it, according to the CEO in the last conference call. So there's some good things going on there, and I think long term it'll be all right. Also, Mattel, 5 to 7 year hold, $10 a stock, one of the larger global integrated steel companies. The economic recovery does in fact take hold over the next 5 to 7 years. This stock, easy double, probable triple. In all of these cases, I'll hold off saying this about Weight Watchers and Avon because I haven't really dug deep enough recently to say, but I don't think they're going out of business. I think they're in good position to survive until they thrive and give you that 2.5, 3 to 1 payoff, dollars in, dollars out ratio that the private equity guys like to talk about. Really, what you're trying to apply here, much like the private equity guys do, is a wonderful combination of time and common sense. Is the asset, the company, cheap? Okay, why is it cheap? Can it recover? Why will it recover? When it recovers, what will the stock price be? Not tomorrow, not next week, 5 to 7 years down the road. That's what you need to be thinking about, looking at these companies in terms of long-term recovery potential. And you can accomplish all this in the tools that I use in trying to put together these private equity-like portfolios, okay? Enterprise value to earnings before interest and taxes. Tobias Carlisle has done some fantastic work on that over the past couple of years. He's converted me. Now, I did not give up price to tangible book value. I probably never will, but I've certainly added the EBIT ratio to my toolbox because it's effective. It's what the LBO and private equity guys use to look for stocks. It works. It's worked extraordinarily well over long periods of time. So into the toolbox it goes. Price to tangible book value has worked well for me for almost 30 years now. I'm pretty sure it'll continue to work well for the rest of my investing life, especially when I add some credit score tools to these stocks that I find with cheap enterprise ratios and cheap price to book values. I want to use the Altman Z-scores and the Piotrowski F-scores to determine that, in fact, I have a company that can survive until it thrives and where the financial conditions and fundamentals of the company are improving over the prior quarter and prior year ago period. So I can mix all this up. I can come up with a list of safe and cheap companies that have the potential to give me that 2.5 to 1 return ratio that I'm looking for over the next 5 to 7 years. And maybe if I'm lucky, it's even a little higher than that. So now, the other thing that we want to use is, they talk about taking advantage of illiquid opportunities. You know where I'm going, right? Right back to the small community banks, all right? We know from the various studies that have been done that if you buy one of these little banks at less than 90% of tangible book value with a clean loan portfolio, a decent balance sheet with enough equity capital in the business to deal with changing conditions, that has an activist investor, you're going to make a lot of money. historically about a third of these situations get taken over. Now, that's page into positive territory right there most of the time, but a lot of these other banks are going to be at, with pressure from the activists, raising dividends, buying back stock below book value, and doing all sorts of things that increase shareholder value over time. And a portfolio of those, I believe, is going to easily, over a 5 to 7 year time frame, that private equity mindset time frame, give you at least a 2.5 to 1 return on your money, getting you up there into and closer to that 20% a year threshold that Steve Schwarzman and other private equity investors have talked about. So, look, it's not rocket science. It's hard to do. The patience and discipline to adopt the private equity mindset, going from that 5 to 7 week mindset that you've got right now to a 5 to 7 year mindset, is a very difficult thing to do for most of us. But adopting that approach is going to dramatically improve your investment returns over time. You've got to learn to ignore the day-to-day, focus instead on the financial conditions of the companies that you own. If it's worsening, you sell them. If they're improving or staying the same, hold on to the company, allow it to survive until it can thrive again. And the holding period that I've always talked about somewhat is until it works. So that's the time frame we kind of need to be using here. Definitely extending it out, thinking much more like a private equity investor than a trader of short-term stuff. Now, a couple other things to mention about the private equity industry right now at this given point in time. First off, they're selling a lot more than they're buying. Valuations are high. Realizations are very high across the industry. The buying to selling ratio is at one of the highest levels in some time across the private equity industry. Wilbur Ross late last year said for every deal he was buying, he was selling 6. So there's not a lot to buy out there. We all want to rush out and get the money to work. It's not always necessary. Brings me to my next point of view. There is $1 trillion of dry powder, uncalled cash, and cash on hand in the funds available to the private equity industry right now. It's sitting there because they can't find enough stuff to buy. And as I said, if you're selling 6 for every one that you buy, it's very tough to whittle down your cash balance. If we put Blackstone's uncalled cash balances of about $82 billion together with their assets under management and any cash currently in the funds, they're going to be somewhere between 20 to 25% cash on hand right now, because valuations across the board in just about every asset class, every sector, with the exception of stuff like coal and energy. And again, once you apply the credit metrics, it's really hard to find solid opportunities in that space. There's a couple, but there's not a lot. So cash should be a part of your portfolio at this point in time, even if you're using the private equity mindset. High valuations are usually followed by low valuations, and you get a chance to put that cash to work on a very favorable basis. But guys, we have absolutely got to start thinking more like long-term private equity owners of the companies that we buy, and a lot less like short-term traders. There is a reason there are very few superstar traders. It is phenomenally hard to do, and it cannot be done part-time. Okay, so anyway, that's all I've got down here. I do want to share with you guys that I discovered a new series of novels. It's by A.J. Stewart. The main character is a guy named Miami Jones. He's a private detective type guy. This is not literature. This is fun. It's beach reading. It's relaxing reading. But the books are surprisingly good. They're set down here, of course, in Florida, over in the Fort Lauderdale area. Main characters all hang out at a bar called Longboat Key, which sounds suspiciously in description like my old haunt up on the Chesapeake Bay Red Ice Dock Bar. And most of the stories have sort of a sports-themed background. So you've got Florida, a dock bar, good private detective mystery novel with a sports theme. That's almost literary heaven for me. So if you've got the same kind of bent and you're looking for something just fun to read, those are fantastic books. Anyway, guys, I got to run here. Got a conference call coming up. This is Tim Melvin of the Deep Value Letter and Banking on Profits Report. Hoping you have a great week and drift ever closer to having that private equity mindset that can make you so much more money.